Right now, the British housing market is not crashing in one clean, dramatic wave like many headlines want you to believe. What's actually happening is far more unsettling because it's creating a sharp and growing divide between people who are quietly making serious money and those watching their wealth drain away month by month. This isn't random chaos. It's a reshuffling of wealth happening in real time, and understanding which side of this divide you're on could shape your financial future for decades. As we sit here in early 2025, something unprecedented is unfolding. In one postcode, property prices are rising steadily, while just a few miles down the road, values are sliding backwards. Neighboring areas are experiencing completely opposite outcomes. This isn't luck, and it isn't coincidence. It's the result of deep structural changes in how people live, work, and invest. And the data coming through shows most homeowners are not prepared for what it means. Take London, for example. Properties under the £500,000 mark have suddenly become hot again. Flats in zones 3 and 4, which were completely out of reach during the post-pandemic frenzy, are now being snapped up by buyers who couldn't compete 2 years ago. At the same time, luxury apartments in prime central London are sitting empty. Sellers in areas like Kensington and Chelsea are slashing asking prices by hundreds of thousands just to attract interest. Estate agents in these prime districts are reporting their quietest January in over a decade, while agents in places like Lewisham and Croydon are overwhelmed with viewings. And if you want to stay ahead of what's really happening in UK property and the wider economy, make sure you like the video and subscribe, because we're cutting through the noise and showing you what the data actually says. What's even more surprising is how the traditional north-south divide has flipped. For decades, London and the south-east were the unquestioned winners, but now northern cities are stealing the spotlight. Manchester and Liverpool are seeing price growth. London hasn't enjoyed since before the pandemic. Greater Manchester prices rose by over 4% recently, while Greater London declined. That's not a blip. That's a fundamental shift in how location is valued in the UK. Birmingham has recorded its strongest quarter for new buyer registrations since the late 1990s. Newcastle viewings are up dramatically year on year. Leeds has seen a huge jump in mortgage approvals compared to last January. These are the kinds of numbers you only see when serious money is flowing into a market. Investors and owner-occupiers alike are voting with their feet, and increasingly, they're voting north. Remote work is the engine behind much of this shift. Despite predictions that working from home would fade away, it has become permanent for millions. Companies that once demanded a full office return quietly reversed course after losing staff to more flexible competitors. This means London salaries can now be earned from Manchester, Leeds, or Newcastle. Suddenly, a 3-bedroom house with a garden looks far more appealing than a cramped London flat at double the price. But the divide doesn't stop at geography. Property type is now one of the biggest separators between winners and losers. Family homes with 3 or more bedrooms are selling fast and often above expectations. Smaller flats, especially 1- and 2-bed apartments, are being heavily discounted. In cities like Bristol, 3-bed houses sell in weeks, while nearby apartments can sit unsold for months. Families are the dominant buyers right now, and the market is bending to their demands. The build-to-rent sector tells another cautionary story. Over the last 5 years, investors poured billions into purpose-built rental apartments, convinced they were guaranteed gold mines. Now vacancy rates are climbing sharply. In parts of Manchester, 1 in 5 units is empty. In Birmingham's city centre, landlords are offering free rent incentives just to attract tenants. Institutional investors are quietly looking for exit routes, while smaller landlords with traditional suburban houses are enjoying some of their strongest returns in years. Interest rates remain the elephant in the room, but their impact is deeply uneven. Homeowners who locked in ultra-low fixed rates before the Bank of England hikes are living in a completely different reality to those remortgaging now. For many households, monthly payments have jumped by hundreds of pounds overnight. This pressure is forcing sales that would never have happened otherwise. These aren't reckless borrowers. They're middle-class families who followed the rules and were caught by a sudden policy shift. That pain is creating opportunity for others. Cash buyers and buyers with small mortgages have enormous leverage. Sellers who once rejected offers below asking price are now willing to negotiate hard. Some first-time buyers with large deposits, often helped by family, are securing discounts of 10 to 15%. But for buyers reliant on high loan-to-value mortgages, the door remains firmly shut. High interest rates mean monthly payments barely reduce the loan at all, making ownership feel pointless compared to renting. Then there's the growing scandal around build quality. New developments built between 2015 and 2022 are increasingly being flagged for serious defects, from fire safety issues to structural problems. Many of these properties are now unmortgageable and effectively unsellable. Entire blocks in cities like Leeds and Manchester are stuck in legal limbo, trapping owners who can't sell or remortgage. Buyers are becoming far more cautious, commissioning independent surveys even on brand new homes. Energy efficiency has also become a major price driver. Homes with decent EPC ratings are commanding premiums, while inefficient properties are being discounted heavily. Buyers know expensive upgrades are coming, even if deadlines keep being pushed back. Landlords with poorly rated properties face an impossible choice: spend tens of thousands upgrading or sell at a loss. Many are choosing to exit the market entirely, reducing rental supply and pushing rents even higher for good quality homes. Outside England, the picture varies again. Scotland has remained relatively stable, attracting investors tired of volatility. Wales shows a split between strong coastal markets and struggling industrial towns. Northern Ireland, often overlooked, is quietly outperforming, with Belfast benefiting from tech growth and buyers priced out of Dublin looking across the border for value. Leasehold properties are becoming increasingly toxic, especially flats with short leases or escalating ground rents. Despite promises of reform, buyers are treating leasehold as a serious negative, demanding steep discounts or walking away entirely. Meanwhile, many new build estates on city fringes are slipping into negative equity as promised infrastructure fails to materialize, leaving residents isolated and unable to sell without losses. What's emerging most clearly is a patchwork of micro-markets. It's no longer about north versus south. It's about specific towns, streets, and even school catchments. Two houses minutes apart can experience totally different price trajectories. Blanket statements about regions are becoming meaningless unless you drill down into the details. Auction sales are rising sharply, a classic warning sign. More ordinary homes are being auctioned because sellers need certainty and the traditional market isn't delivering. Cash buyers dominate these auctions, further widening the wealth gap. Those with capital can move quickly and accumulate assets, while those reliant on borrowing face mounting barriers. This feeds into a much deeper generational divide. For many millennials and Gen Z buyers without family help, home ownership is becoming unattainable. Inheritance and family wealth are now the main routes onto the ladder. The uncomfortable truth is that UK property needs lower prices, but politically, a major crash is impossible. Instead, we're seeing a slow managed decline through inflation, where prices stagnate in cash terms but fall in real value. Looking ahead, these trends are unlikely to reverse. Interest rates may ease slightly, but the era of ultra-cheap money is over. The market reset underway is structural, not temporary. Family homes in strong locations will hold value. Poor quality flats with legal or energy issues will continue to struggle. The UK housing market is no longer a guaranteed wealth machine. It's a selective game, rewarding those who understand the new rules and punishing those who don't. And that's the reality most people aren't being told.